Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. Hopefully we are coming through live this time. It appears that we are on take number 2 here, but welcome on in. Hope everyone is doing all right out there. Obviously, a lot going on in the financial world today. As last week, we had Vince on live, and we had issues in the U.S. banking sector with Silicon Valley Bank, Signature Bank, and the issues that were happening there over the weekend. And really over the past week, we had the issues with Credit Suisse escalate, leading to their takeover by UBS over the weekend. So a lot happening. Not ideal conditions, but as you can see, Professor Lanci stretching it out there. I know he's got plenty to say today. So Vince Lanci, Echo Bay Partners, contributor here to Arcadia Economics as well, and founder of Goldfix Substack. Great to have you back on the show today at a time where I'm sure people could benefit from your insights. So how are you today, my friend?
I'm good. Thanks, first of all. And second of all, I thought today was supposed to be your day off, but we have to keep doing these live things until these people will stop screwing our system up. So I apologize for getting away from your entertainment, or whatever it is you're doing. But
well, live streams until inevitable. So at that rate, it seems like. But great to be here with you today, though. And perhaps to start, can you walk through the last week of events at Credit Suisse? First Boston, we had risk on, risk off for midweek last week. Then we had the news that they were going to get a loan from the Swiss Central Bank. Seems like that didn't stem the tide, and maybe you could start there and give us an idea of what happened leading to the takeover yesterday.
Sure. Over the weekend, well, first of all, Credit Suisse has no money, right? They don't have enough tier 1 capital, and that just means enough money to be liquid under their laws. Over the weekend, they had a negotiation with UBS to be bought out, to be absorbed, however you want to talk about it. And it was a volatile weekend to begin with. What happened was, without getting too granular, but what happened was, as the two were merging, the risk in UBS, the risk in Credit Suisse started being reflected too much in UBS. And so that became a sticking point for them. Credit Suisse has, as someone just said here, massive derivative exposure, right? They're basically like Deutsche Bank was a few years ago. So CS had to be purchased by UBS, and it was like $3 billion. I'm not really sure the price, but that was supposed to calm everyone down, and it did not, right? So the US had to help. The US had to not reopen, but they're already open. Had to they're already established. They had to reopen the swap lines with Europe. So in order for UBS, Credit Suisse to have enough tier 1 capital as an entity, they need to get more money. In order to get more money, they need to back the euro. In order to back the euro and stop people from running out of the euro into dollars, they have to make sure there's enough dollars available to swap for euros. So right now we're doing dollar-euro swaps. If you're old enough, this is what happened during Brexit. When there was a Brexit vote in 2016, when it just blew up in everyone's face, what you saw then was gold, and actually gold led, but silver exploded because people were saying the euro is going to zero. Let me put my money in something safe, right? They were putting their money in dollars and gold at the same time. There were a lot of shorts in silver then, a lot. And eventually silver caught fire and actually followed. Then the US opened the swap window, we'll call it, with Europe, basically giving them access to our central bank. And by doing that, we supported the euro and we sold dollars and made dollars more accessible. And that stopped the crisis from Brexit. That's what they're doing now. And it will work. So I mean, volatility is not gonna go away tomorrow, but it will work. It won't fix anything. It's a Band-Aid on a bullet hole, but it will work.
Well, that's encouraging to hear because, again, we did have a statement out from Janet Yellen and Jerome Powell last night. Second Sunday night statement in a row. And they mentioned, we welcome the announcements by the Swiss authorities to support financial stability. Capital and liquidity positions of U.S. banking system are strong, and the U.S. financial system is resilient. Thoughts on that one?
Yeah, those two are going to be fired. How's that? That's my first thought. Not tomorrow, but those two are going to be fired. That's what they have to say. That's what they have to say. I mean, there's real. I mean, this is template. This is boilerplate. We welcome the announcements by the Swiss. First of all, I say the most significant thing is that they're saying things at the same time. Yellen and Powell, it's kind of, they're not on the same page monetarily. Powell wants to keep hiking. Yellen wants to lower rates. So for them to put out a joint statement is to at least show the important people that they're on the same page for this. So that's really all I can say about that. But they're going to get fired. Yeah.
Yeah, and where does this leave us back to the U.S., though? Obviously, we had the issues last week. I'm sure this didn't help make things any more stable. Where does that leave the situation that we were discussing last Monday when we did this call?
Well, this is happening right now. So while the CS deal is going down, the UBS deal is going down, which is big enough. The echo back here was how, basically, is the Fed going to pivot, right? That's what everyone's saying. Is the Fed going to pivot? And the answer is yes, still not yet. And we could find out on Wednesday. But what happened is, very, very, very briefly, is the banks that had money taken out of them, and that money went to the big banks. The big banks, like JP Morgan predominantly, will be loaning money back to those banks. Basically, stealing is not the right word, but poaching customers from the bank and then loaning the money back. So it's kind of like, you need protection from us, basically. So they're lending them their own customer money back, in part, and they're going to give them that loan for 2 years. In addition, with the federal government saying, we're going to loan you money on the face value of your assets, which is ridiculous, but it's what they want to do right now. It's a lesser evil right now. And I can say to you that the banking crisis with these other banks, these FRC and all these other regional banks, that's over. In 2 years, JP Morgan's probably going to own, and a couple other banks are probably going to own most of the good ones, and the other ones will be gone. So that's the answer to that. I want to talk about silver because, there's these two things taken together. If I can, Chris, really, it's about an uncomfortable choice the Fed has to make. And I'd like to just talk about that for a second and then take some questions if you're okay with that.
Sure, please.
Okay. I had a conversation with a real estate guy on the domestic front, on the commercial real estate thing, and he left me with some important points. And then I went back and I did some reading on some things that were about this. And the question that I'm asking myself is, what, and I have some notes here, so I want to read them. Hopefully I don't sound stilted. What can be said about the big picture right now? Well, the Fed has been raising interest rates like crazy, but the natural way for inflation to go from 10% to 2% is through a serious recession. All economic activity must slow down, not just the ones they don't like, right? But they can't do that. They're trying to just make the bad stuff go down in their mind. So right now we've got 30 trillion on central banks' balance sheets. What happens when a recession is in full force, which is what we're going to have right now? Do the central bank balance sheets go to 50 trillion? The cure for insolvency, which is what banks are dealing with, is printing. So based on how these people operate, the cure for this crisis is only to print more money because they cannot stand having even a small recession for years. Now they can either debase the money totally, which is what they're not doing yet, or cause an economic depression, which is what they're not doing yet. They will choose debasement. And here's what I mean. By not printing money yet, they are directing banks to loan money that they will loan to them. And they're not creating the money to go into the stock market. That money is going to go right into these banks. So it will stabilize the banks. And then they'll worry about the stock market later. Look, after this happens, they're going to have to print again, because the commercial real estate market is going to get crushed. And when it does, we're either going to have a depression or they're going to have to print. And if they print, and I'm not making this up, the world is on the path to hyperinflation. It's the direct route to global societal collapse and civil or even international strife. It's not baked in yet, but it's the path that we're going on. You know, like, why? I can't believe the Fed's not asking themselves, why isn't their method of fighting inflation working anymore? And the Fed is trying to fight the price rises by raising interest rates, only to rediscover a fragile financial system and institutions. Asset prices are falling. They wanted that to happen. At which point policymakers will respond by printing more money. Not yet, but soon, right? And it'll exacerbate and start a new cycle of price rises. Central bankers, whether it's Powell or who replaces him, and Treasury officials, whether it's Yellen or who comes after her, promise too much, borrow too much, and instead of meeting their country's obligations, try to depreciate the currency in which they, or the next guy down the road, well, they, meaning you, will have to pay back those obligations when it is no longer possible to kick the can down the road any further. Look, this is as old as the hills. You don't need to be a math genius to understand. It's a terrible path and a poor alternative to sound money. People are going to start talking. Yeah, I'm sorry.
Quick question, if I may, because there's a call you did about a month ago with Tom Luongo. It was an interesting call, to say the least. People can find this on Tom Luongo's podcast, and Google Vince Lanci and Tom Luongo, episode 135. Tom is still of the school of thought that the Fed is going to raise interest rates, continue raising interest rates, and not going to go the path that you suggest, or that a lot of us think, of just reverting to printing money. And again, since you caught up with him recently, I know you're familiar with his research, and certainly a very sharp guy. Any thoughts on that and the alternate possibility that he suggests?
I'm more in the zero hedge camp that the Fed's going to ease, but let me address his point. His policy point is Powell's not going to ease because Powell is worried about America. And he's not trying to be patriotic. He's saying Powell represents the banks. Now, the central bank represents the US banks, and therefore he's going to do what he has to do to protect them. If we have a big rise in inflation, if he doesn't fight inflation, eventually the US becomes like Europe, and eventually the banks are down the road obviated from being needed, you know, MMT and all that other nonsense. And he thinks that Powell's going to stick it out and not raise rates. And he's doubling down saying that. And I would welcome a conversation with him about it, but I don't think it's going to be an argument. And I think if we had a conversation, it would go like this. Either Powell lowers rates or they're going to replace him. And the next person is going to lower rates. Now, without being cynical about it, if they're not, let's assume they're not going to replace Powell, right? Forget that idea that I have. Forget that. I think Powell is doing everything. This is in Tom's defense. Powell is doing everything he can to not lower rates. Everything they're doing is not lowering rates. They're lending money, but not giving money. They're having JP Morgan bail someone out, and they're just giving money to JP Morgan. They trust JP Morgan. They're opening credit swap lines, which are not inflationary. They are alleviations of deflation. They're loaning them money that's going to be called back. So everything Powell is doing, or not doing, actually, says that Tom is right. And he'll be right until he's wrong. I think he's taking a risk, if he's listening. I think he's taking a risk in saying Powell will never hike. And I really don't think that he thinks that. I do know that I do believe that Tom is 100% right on his perception of Powell's state of mind. He does not want to raise rates. He does not want to lower rates. He does not want to be known as Burns. We all can grab that, right? He also needs to make sure that the banks are protected, his clients, basically. And he really believes that inflation's a problem. So I think that Tom's comment about Powell not easing or continuing to raise, I would not be shocked if he continued to raise. I would be surprised if he raised right now. That's it. I don't think he's going to raise right now, and I think he might pause the raising. I don't think he's going to ease. But it's really a matter of, like, we're debating minutia. Everything else Powell's doing, or Yellen is doing in conjunction with Powell, is not going to end well unless they either eventually print a lot more money or we have a severe economic contraction. And that's it. So I think Tom is right. I'm actually 50-50. Powell gets replaced or Powell eases down the road. I think there's a chance he doesn't ease if the commercial real estate market gets bailed out by Yellen. So that's basically it. His point is very valid. He has another point I just want to throw in there. He sees it as financially, aside from the whole China-Russia thing, he sees it as financially, and you know what? I can't argue with him on this. This is actually a good point. The U.S. has been a lifeline to Europe forever, since World War II. And now that we're all fighting for our lives and the world is deglobalizing, I have noticed this, central banks are no longer working together. So when Europe established Basel III, it really was kind of like a fuck you to the US, meaning they said that we're going to allow gold to be counted as tier 1 capital, which means when you have a crisis like this in Credit Suisse, you're not going to have them selling their gold to buy domestic bonds to get 100% face value. You're not getting that. You're getting them saying, well, I don't have to sell my gold anymore. So they hold on to it. So Europe is preparing to revalue gold on their balance sheets. The US, meanwhile, is giving them credit lines, but not quickly, not like last time. I don't think they're giving them as much money as they did last time. I don't think that we're being kind to them. Look, China's supporting Russia. We're supporting Europe. And we're not doing Europe any problems, any favors that are going to hurt us. I think he's got a lot of good points about that.
All right, fair enough. And something that you mentioned in there, we also talked about this one last week. Expectations for Wednesday. I know last week you said you did not think that they would end up doing their quarter-point hike. We saw the probability of no hike at as high as 50%. Looks like it's about 3 to 1 today at 27%. So a favorite of a 25-point hike. Any thoughts on what we might see on Wednesday?
I don't even think he knows right now, but I think here's what he's saying and here's what the market is saying. And when I say he, I mean Nick Tamaros. They think they're going to hike 25 basis points. I mean, in their mind, right? They think we're going to hike 25 basis points and see how the market handles it. I think the market handles it poorly. That's what I think. And the reason I think the market handles it poorly, as I said before, is because if you raise interest rates on the 25 basis points, then another level of banks that are on the cusp of blowing out are going to blow out. They're going to have a run. they're going to lose depositors. They're going to have securities go underwater. So every time they raise 25 basis points, it's like you're trimming off more dead wood. So if this facility is secured by Wednesday, this whole JP Morgan's going to, the RRP money is going to come out. JP Morgan's going to lend these banks that are, JP Morgan's basically going to be the broker for the government. Then he can raise 25 basis points. The stock market will crap out and he'll be okay because there won't be any more bank runs. So I think he still wants to raise. But I think it's 50-50 now. It's not really a lot of help. I'm not really good at predicting short-term behavior. Hopefully I am good at handicapping long-term outcomes.
All righty. Well, will be an interesting couple of days to come. And like you said, who knows what will happen by Wednesday. With that said, if people want to start firing some questions that they have on their mind into the chat, I'll start taking those now. And actually, we already had our first question from Superfan Jake out there, who he's got my cell phone number, so he sent this one in direct. And you touched on this a little bit before, Vince, of the idea, are the big banks basically using some of these conditions to crush some of the little banks? And before we get to your answer, I'll play this clip. Some people may have seen this, but interesting testimony with Janet Yellen here. So play a couple seconds. If we get to the point where you need me to pause and you can't, you have to say something, jump in at any time. But let me play a little bit of this here. Had it all timed out, and let's hit the refresh on this one and try that again.
A couple things. Let me start with that. Don't have time. I need to be able to drill in on a couple things. Let me start with some of the banking issues we're dealing with on it.
You can hear me okay, Vince?
Every community bank
I hear it,
in Oklahoma, regardless of their size,
lower than your voice, but it's there.
be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVBP just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is
Can you pause that? Can you pause that?
Go for it.
Dude, this is it. This is it. I'm going to first, this is her logic. And it's not that it's wrong. It's that she doesn't know that it's wrong. She's saying, we're committing triage here. I'm going to cut off a couple fingers to save the body. And if a small rural bank goes under, then so be it, as long as it doesn't infect the whole system. So first of all, they don't fucking know what they're talking about with regards to how they measure the infection of a system. They're not really good at network effects. Second of all, and this is key. He's gonna bring up the next part, which is the best part. The policy, by telling the world that you are telling depositors to pull their money out of the regional bank and put it in JP Morgan, you're encouraging the bank run that you're basically having people cut off fingers before they need to be removed. Pretty soon we're not going to be able to grab any food. We have no fingers left. This is ridiculous. And here's why it's even more ridiculous. 80 to 90%, I'm not exaggerating, of all commercial real estate mortgages and loans are secured by regional banks. Why? Because commercial banks deal nationally and internationally. Regional banks deal with regional businessmen. That mall, that businessman, that shopping center, that businessman, that office park, they're all local banks. And they use commercial real estate, the real estate that they put their business in. They use it to secure the mortgages. They use it to get loans against their business. They use it to guarantee inventory. 80 to 90% of the country's real estate financing at the corporate level is done locally. If you let enough local banks go under, you crash the commercial real estate market, which is going to crash anyway. It is. And what that's going to do, if they don't print money later on, what that's going to do is that's going to crater us into a depression. If you can't get a loan against your property to run your business, then you don't have a business. It's done. It's like you've destroyed everything. She's encouraging, to put it in a sentence, she's encouraging a run on smaller banks to consolidate even more in a too big to fail environment. And in the end, that means there will be no regional loans for commercial real estate. Mortgages will go under, and they're going to have to print money to rescue those mortgages anyway. I'm sorry, this just infuriates me, because I can't tell if she's ignorant or if she's being disingenuous. I'm sorry, go ahead. That just really pisses me off.
All right, we'll play a couple more seconds to get you riled up once more, and then I believe Swam in the chat has the next question coming in, but we'll give you a little more, Janet.
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is what encouraging is, you moron. Oh my God.
Well, I mean, I think you nailed it in your previous comments, where, I mean, it is what's happening, and she's trying to avoid.
Chris, I want to ask you a question. When she says that's not what we're encouraging, do you think she means, I'm trying to figure out if she's dumb or evil. Do you think she means, oh, they're misunderstanding us, meaning she actually believes it? Or do you think she's saying, let me use the word encouraging to cover my tracks? Like, what do you think?
I mean, I think she's trying to protect against the bank run, and if that means that it's a problem for the smaller banks, so be it. And, you know, the guy's calling it out like it is, and she's trying to diplomatically avoid saying that, yes, that's basically, I mean, it's kind of like, well, we're not encouraging it, but I don't know, if it happens, so be it. And
yeah,
that's my take on what.
I mean, if everyone's insured at $250,000, which is not a lot compared to inflation over the last 40 years, if everyone is insured at $250,000, then everyone is insured at $250,000. If you don't want people that have too much money in, so let's say I have $251,000, right? And Netflix has $45 million or $450 million, right? I'm going to lose $1,000 and they're not going to lose anything. That's not constitutional. That's not what the FDIC, either you insure everyone or you insure no one. Otherwise, you're giving dollars votes instead of people. It's absurd. It's obscene.
Well, why start following the Constitution now when we're this late in the game? So we'll leave Janet for now. Keep your blood pressure in healthy shape there. Did have a question from Swam. You only live once. Asking, is it possible that Wednesday First Republic Bank collapses after a Fed interest rate hike? You didn't talk about them specifically, but talk about that possibility.
I can answer that quickly. I think the chances of First Republic Bank collapsing are almost, meaning going bankrupt, closing down, are almost zero. The negotiation goes like this. First Republic Bank, they do a negotiation with JP Morgan. We'll simplify it. JP Morgan says, we'll give you money, and it's negotiation terms. So it's kind of semi-free market. And the Fed says, we'll okay it. Now, I think, thinking about my rant, what the government is realizing now is that so much of this commercial real estate market is local that you can't let it go on. This is what I just said. And so they're going to give First Reserve Bank, FRB, First Republic Bank, I'm thinking the Federal Reserve, sorry. First Republic Bank, a lifeline for 2 years, a loan. We'll loan you, what's your 1970 Chevy Malibu worth? $200? We'll give you sticker value for it from like fucking, 2025. Like that's what they're doing, right? So we're going to give you money of something that's not worth what you say it is to hold you over. JP Morgan, we're going to send out and let them do free market stuff and say, well, your bank does this, and this wrong. And eventually 2 years from now or sooner, the loans will be closed out and JP Morgan will already have your clients, or they like you so much would be a division of JP Morgan. I mean, JP Morgan Chase was it I grew up in, a lot of my time was spent in New York. I had a bank account at Manufacturers Hanover, and then they were bought by Chemical, and then Chemical was bought by Chase, and then they're all bought by JP Morgan. I mean, it's all being rolled up into one big fucking tree in the forest that's sucking all the sunlight out of anyone else that lives there. Anyway, so to answer his question, I do not think they will be bought out, which means, they will collapse, which means if you're looking at the price of the stock, that doesn't mean any price is safe. It means that it's going to go like this while they're not being bought out and people aren't sure. But meanwhile, you're like, oh, I want to buy it. Maybe you buy it up here. It's a bad move because the price will not reflect the value. They don't know the value right now. Hope that helps.
All righty. And by the way, if they give you a loan against that car, they may even inflation adjust it, probably using the shadow stats inflation rate really to get as much money out there as possible. Next question comes in from Daniel Waters that I guess is a variation of something that's probably on a lot of people's minds. Silver Moonshot is sputtering. What's the catalyst for ignition? Vince, were you surprised that the metals opened lower? I also got some messages from my friend John Adams, who people knows over in Australia, and he was actually mentioning how the Bitcoin price has spiked up quite a bit, expecting move higher gold and silver on the open, which I guess I've been beaten over the head with a shovel enough times to. There's some part of me was thinking like, yeah, you'd think the metals would be open higher, and that somehow they wouldn't. Sure enough, they didn't. Any thoughts on what's it going to take to move this silver price?
Actually, yeah, there are what's the word I'm looking for? There are not postmarks, signposts. There are signposts along the way that make me feel confident without timing it. And the signpost was Basel III, right? That told me that when they did Basel III, they're going to help gold more than silver. Silver will be firm from Basel III, but gold is going to go up more. They're going to be buying gold at the central bank level. But to answer the silver thing, the next event I have is when Europe revalues gold on its balance sheet. The day that happens, and it's going to happen, if silver doesn't skyrocket on that day, then I'm going to be worried, because the day that Europe revalues gold from whatever they bought it for whatever it's actually trading for, that's going to encourage them to buy more. And at that point, every European will be buying silver. And they're not silver buyers in Europe. Germany used to be. So my first big signpost is, if Europe talks more about revaluing gold for its balance sheet, silver is going to rocket. And I don't want to depress you, but because gold has been made tier one capital and they haven't done that with silver, you're going to see the silver gold ratio trade up because the central banks are buying gold, not silver. But you're going to see, we're in the beginning of we're in it now. It's not like we're waiting for it. We're in it. We're in the beginning of paradigm shift, sea change, and real money is needed. What's happening now is the first thing bought is gold, because central banks can put it on their balance sheet. They already have it. The second thing bought is silver, and that's bought by sovereign wealth funds. Swiss National Bank will buy it as well. That's bought by countries like India, and they've been buying the shit out of it anyway, right? That's bought by Russia, probably through India. Who the hell knows? That's bought by China, bought by Japan, and they're not going to announce that they're buying it until they're done buying it. So the answer is gold will climb for years, silver will spike overnight. And don't underestimate the government's ability to keep a lid on it all the way there. Like today, for example. Today, I was like, gold's down $17, something was the other night. And I'm like, okay, this makes sense. I think that's going to happen, right? And then I woke up this morning at 5 and I'm like, oh shit, it's up again. That's really cool. And then I went, oh, Europe is buying gold. I said, well, let's see what the US does to address whatever's going on in Europe. And they addressed it, and that knocked gold down. Last time, if you look back, last time the US dropped the swap option for Europe, gold and silver crapped out a lot more. So we're talking about $20 lower from where this all started, but it's actually $100 higher from when it all just started. So to answer the question, I'm buying dips. I'm buying dips based on news events. I'm not buying rallies based on news events. That's how I'm looking at it. And as an investor, I'm just going to be buying more. I'm waiting to buy more. I want a lower price. That's what I'm saying to you. I want a lower price. I'm not fucking convinced this is happening. That's how convinced I am. That's it.
Alrighty. Interesting question here from John Smith. He asks, what will actually cause the derivatives to implode?
Well, they already have, John. They already have. What's going on in you're referring to Credit Suisse, right? Or are you referring to silver derivatives and specifically? What do you mean?
I would imagine he's talking about just the massive derivative bubble in general, but we'll see if he wants to type in a follow-up there.
Yeah, if they're not going to let the derivatives bubble collapse, well, they have two choices, right? If they let the derivatives, we're going to create zombies everywhere, right? So if it's kind of like this, Credit Suisse has a balance sheet, right? And if they let the derivatives collapse, then whoever has the other side of derivatives, they're also going to be unable to conduct business, which will create major deflation, depressionary deflation. Businesses will stop. Everything will sell off. And then gold and silver will be bought and go up. All right. If they don't let the derivatives collapse, they stop that by saying, okay, we're going to bail you out. We're going to give you money at face value, right? Think about it. I'm going to give you money at face value of your derivatives book, even though it's underwater. Why are we doing that? Because we want the economy to keep moving. Now, that's not in and of itself inflationary, because the money is going right to the bank that needs it. And it's not allowed to use that money except to make themselves whole. But when that doesn't work, making the derivatives whole, having JP Morgan come in, then you have to just print money, give it to everyone. And that's when you have what you have. You're not going to answer your question, you're not going to see wholesale derivatives collapse. You're not going to see 20% inflation on a headline. You're not going to see gold and silver go to infinity on CNBC. It'll be at infinity. Silver's going to be up $100 one day, okay? And the headline on CNBC will be, silver closes off the highs. That'll be the headline, because they're owned. They're owned. You know, that's the way it is. When every bank in Europe collapses except one, they're going to say, UBS rescues Europe. And they'll keep doing that until we're all broke 20 years from now. And we'll be broke because taxes go up, quality of living goes down, and we don't have enough silver and gold. But to answer your question straight up, they will not let the derivatives go under. Think of the derivatives contracts as legal contracts. They'll let a bank go under and be absorbed by someone else. That's it.
All righty. And again, if people want to fire some more questions in there, we'll take those. Perhaps if you can tag Arcadia Economics on your question, makes it a little easier to see. Although Edge Brand Agency had a comment, I believe this was going back to Janet Yellen. He wanted me to read here. It's hard not to laugh at the obfuscation and diversion, but she's doing what she has to at this point. The damage has already been incurred. There is no easy way to resolve the hole in the Titanic. As we talked about last week, Vince, I agree with that. It's kind of a little late for any sort of easy solution or answer, except if we could go back and yank Bernanke out of there before,
Right.
or even maybe further back than that. But any thoughts on that?
I think she's right. I like the Titanic analogy because I have a new piece of information about the Titanic that I think is fascinating. The analogy of the Titanic, it's big, it's slow, the iceberg it's going towards the iceberg, it can't steer fast enough, so it throws all the people in the front, all the dummies in the front, all the mattresses and all the things they can to slow it down, but all the rich people were in the back. Here's somebody told me about the Titanic yesterday, and Bernanke and Greenspan before him fit this analogy. The reason the Titanic did not get out of the way of the iceberg, this is great, was they fitted it with a rudder that was too small. So it couldn't affect the turn fast enough. So they thought they could get out of the way because of the rudder, but they fit it with a too small of a rudder. The rudder is basically the pilot. It's the thing that turns the boat. And who's the pilot? You know, Bernanke and his generation. That's basically it. So now we have a hole in the boat. That's it.
All righty. Another question I have for you here that I think is shared by many people watching. Have we reached the point where now we're at something like 2008? Obviously, in the past couple of years, there have been many people who were concerned that we were going to get to that point, and we've had a lot of issues pop up, and then things seemingly calm down. Haven't quite hit that break point yet. Do you think that we're now there?
I don't know if we're there because I don't know. And I'll say this. Investors, people like us, should not assume that they have seen everything on account of experiencing 1970s inflation, the oil embargo, the crash of 87, the great financial crisis is what this person is alluding to. With all like that's, and I'm not saying that the person's wrong to think that way, but when you think that way, you think, are we on a path to mirror that? It's worse. It's worse than that. And that's why I don't know when it's going to start. I don't know what it is. Predictions of how much stock and bond and real estate prices are likely to drop, you know, it's masturbatory now. It's a distraction. This will be as big or bigger than the great financial crisis of 07, 08. And the reaction to it will be to make an inflation twice as big as the 70s. When that's going to happen, are we near it? I got to tell you, we're not near it. And that's scary, by the way. I thought we'd be near it. If Powell doesn't lower rates and he doesn't get fired, let's say I'm wrong about that, then we're not near it. They see something that tells them they're in control again, which means it'll be even worse when it happens. So I don't know if we're near it, but I know that it will be like nothing that's ever happened. This is an ecosystem slowly failing due to a loss of faith and an increase in existential fear. It will not move in a straight line when it finally moves. It's happening. I took money out of banks, and let's say I'm rational. What about the people that aren't rational? You know, I mean, it's going to be bad. Hope that helps.
Follow on to that. When that does happen, do we recover in the same sense? I mean, do we have a period of 2009 to 2020, let's call it, or is this things have to change in the basic infrastructure of the financial world we live in?
We do not recover like 2009, 2013. That will not happen. The reason it won't happen is because we're trying to do now what we did in 2009, 2013. And that is print our way, not at this moment, but 2009, 2013 was the beginning of QE. It had never been used before, first time, everybody kind of like, it worked, right? Well, now the market is just way done with that, okay? So it will not be like that. It's not an analogy, it's a parallel. What we're going through right now monetarily is in 2009, 2013, we inspired confidence by printing more money and saying, we got your back. And that worked. Now, if we do that again, half the world isn't on board with us anymore. If we print money saying we got your back, half the world isn't involved. We don't have the network that we had. And, you know, it's not going to work. We're going to have, this is where the whole reset talk comes in. We're going to have a reset. They prefer it be slow. They prefer it be soft. But it's, you know, it's going to be, if they're right, it's soft. And if we think it's going to happen the way we think it's going to happen, it's going to be hard. It's going to be basically fits and starts like this. And we're right now in one of those fits. So the answer is our whole economy is going to change. Whole industries are going to get demolished. Whole industries are going to get demolished. Financial industries, financial services, demolished, killed. Manufacturing of, I don't know, chips, you know, maybe steel, they're going to grow. And those are all good things. The point is they did this. We didn't have to do this. They over leveraged everything.
All righty, which leads into our next question from Robin Hooder here. Silver being drained for fear of a banking collapse. And before you answer that, I have two things I'd like to pull up and show you. Here is from our dear friend Michael Say, or Mike Say, as he goes on Twitter. We'll leave his last name out of it. But he records the APMEX sales, and yesterday's sales at APMEX, second highest I'd ever recorded for a Sunday, behind last Sunday. And you can see last Sunday, certainly quite a big day. I talked with a couple of bullion dealers who said that what they experienced last Sunday and Monday was more extreme than what they saw on an individual day during silver squeeze. Money metals mentioning due to high volume, shipments are delayed. Also see a similar pattern in gold here. And one other thing that perhaps you could comment on as well somewhere in there, saw quite a drop of metal, about 20 million ounces out of SLV in the last couple of days. So thoughts on how people are responding to this, and also anything going on with SLV there?
The APMEX data, you're seeing, you know, the whole silver squeeze concept. You're seeing a rolling short squeeze in silver, meaning it's a little bit of a wave. And now people are thinking about it. And every day that this happens, every time this happens, it's getting bigger and bigger, right? This isn't an event. This happened. They didn't go, like, this wasn't a metals dealer going out and saying, everybody should buy silver. This was people not even having to be told to buy silver, and they did. That's what's going on. This is a snowball. It's just getting started. It's insane. The fact that they're low in inventories, you're going to be able to find silver again, don't get me wrong. But the fact that they're being, it's kind of like Cabbage Patch dolls. It's like and I don't mean that in the negative way, in the positive way I mean it, meaning the inventory gets cleared out. You can't just make these like they're, you know, like Coke and a soda machine, you know, like a fountain soda. You have to get inventory. And these are real physical things, and physical limitations are going to create bottlenecks like we had before. And you're going to have another bottleneck come up. Like, if they don't resolve this right away and they don't get all the week longs to sell silver, this is going to keep happening, getting bigger and bigger and bigger. Yeah, I mean, it's real. It's grassroots. Here's something that someone said to me a long time ago that's really important, and it applies to silver. Government doesn't set the trends in business. Government reacts to the trends in business. Applied to silver or silver coins, the grassroots is to buy sound money now. And when the grassroots gets big enough and they can't stop it, they embrace it. You can't beat them, join them. You can't, oh, oil's great. We don't need electric vehicles. Okay, so many people care about it. So many people who vote care about it. Well, you're going to have that. You're probably going to see silver remonetized state by state, and then the federal government will have to get involved in it. That's the bottom line. With regards to the so I think this silver APMEX thing and other dealers, I think it's a flash of things to come, because this time this had to happen. Next time something less will happen, and we'll have a bigger move in silver, a bigger drawdown in silver. With regards to the ounces being taken out of COMEX, I got to be honest with you. I mean, people are.
Or out of SLV, rather.
I'm sorry, SLV. I'm so used to it, right? COMEX. I don't know what to make of that, because it's actually complicated. I mean, I've looked at it before, and I have to look at each individual event, how it happens. But a lot of times silver coming out is not necessarily bearish. A lot of times silver going in is not bullish. I don't, what did the market do between January and February when it dropped out that much before total metal and trust? Why did it do that? Like back in when it dropped down to these levels before, like what did silver do then? What I'm getting at is the day-to-day price of silver and that chart. I'm not saying you shouldn't pay attention to them. I don't pay attention to them as much anymore, because I know shenanigans are going on. I know that although the custodian can't be putting in silver that he doesn't own in there, the people who are replenishing silver are putting borrowed silver in there. It's happening. That's how they do it. So JP Morgan is not putting borrowed silver in there, but when I have to replenish silver I replenish with borrowed silver. So JP Morgan, as a custodian, they're like, well, we have the silver. It's in our possession. It's ours. We don't care. Meanwhile, the person who put it in, they're borrowing it. That silver's, there's borrowed silver out there. And these whole big swings up and down, I have no idea what's going on anymore. I just don't trust it anymore. I do. When that thing moves down like that and silver rockets or silver collapses, then I'll pay attention, because the correlation's not there anymore. You got to keep looking at it, but it's driving me crazy. Doesn't help much, but that's where I am.
Well, Vince, are we at the point where they're just putting bags of stones in the warehouse to cover that? Figured that'd be a good one to end on for people who have not heard. The LME discovered bags of stones in place of nickel at the warehouse.
Right.
Obviously, encouraging sign, to say the least there. And we've heard a lot of stories of this nature with some of the metal supplies in the past couple of months, but what would you say to that one?
Well, between that, it's almost like it's almost like Russian operatives. I say this laughing. Russian operatives are leaking the truth about Western operations in metal, like, Perth and China, right? Now you've got the nickel thing. I particularly find this humorous, because when Kyle Bass years ago said he bought like $1 million worth of nickels, I bought low 5 figures worth of nickels. And it took me like three or 4 weeks to get it delivered, because they didn't have it in the bank. And that's when I went, oh my God, they can't just get the money. So that's when I wanted them even more. This reminds me of this is going to happen in silver. That's going to happen. And I'll tell you why it's going to happen. The 1 or 2 times that I took delivery of silver, they gave me the heavy bars, which was like spiral. And heavy, what meant it was heavy in impurities, and it was legal, but it was heavy in impurities. So it was basically like the Perth product on gold. And I talked to the guy who understood this. I didn't know physical at that time. I go, what does this mean? What the hell is spiral? He goes, oh, that's crap. We don't take them anymore, but they're already in there. And anytime somebody takes delivery, we give them the crap. And I'm like, oh, so we're basically about like 2 years from them giving us a bag of rocks or aluminum ingots, with rocks inside them that look like silver, but they're heavier. I mean, this is, people are lying. It always comes down to people lie to cover up lies.
Well, welcome to American Finance in 2023, and perhaps for many years prior to this.
Yeah.
It's while what's happening out there. And I guess it's not an accident that we've seen a lot of these things start to unravel. Obviously, the FTX, which just a couple months ago has been quiet for the last little while, but seeing these things happen at the same time, the money supply is getting turned off. Actually, one last thing I did want to get your comment on is the money supply. We talked about this on Twitter last week. Here you have, I'll put our heads up to the top there. Here's from 2008, where Fed balance sheet about 900 billion up to 9 trillion. And then we have quantitative tightening for close to a year now. And in the span of a week, most of that undone. And perhaps this would be a good last question for you to comment on your thoughts there and how quickly it has reversed.
Yeah, I'll give you the knee-jerk reaction, the analysis, and the real bottom line. The knee-jerk reaction, they just undid half of the QT in 1 week. No, they didn't. And I'm not trying to shut people up. No, they didn't yet. And I'm dealing with their definition of the balance sheet, right? They didn't undo QT, but they did increase the balance sheet. You know, it's like, you know, I'm not drinking orange juice. I'm drinking water with oranges in it. Like they're worried about the names. So the first reaction is they reduced they shrunk QT. Well, they're going to tell you no, they didn't, because this isn't bonds being undone. This is loaned money that we're going to call back. It assumes this is why they're wrong. It assumes that they're going to make good on those loans. They're not going to make good on those loans, but we're not going to worry about that for 2 years when we're worried about something else or some other economic problem or some other cause or something else we're distracted by or some butterfly floating around. The real answer is number 3. So it is a balance sheet. It is ending QT. It isn't ending QT. That's them countering. And I'm telling you, it is ending QT because those loans will not be paid back. And they will end up causing them to stop QT altogether and make them more permanent.
Well, we'll just see how that one is looking a week from now, obviously changing quite quickly. And that said, Vince, we're going to start wrapping up for today, but can't thank you enough for joining us again, taking some questions and letting people know what's going on out there. I might add that people can find Vince at Goldfix Substack, where he writes about all of these topics multiple times per day. Link to that is in the description field below. And Vince, anything you'd like to share about the Goldfix Substack or anything you have coming up there?
Yeah, I mean, you know, I'm writing a lot about the bank stuff because that's what's going on right now, and about gold and silver. But yeah, just go there and you know, just try for a week, and you know, anyway, anything you want to do, because you can inquire, just ask Chris. He has a link or something like that. I do have a question about the Ben helicopter thing, though. Are you? I hear that you might have a solution to the whole import stuff. I mean, I want to get one of those. So what do we have to do?
Well, we've been working on a solution to getting Chopper Ben to fly into your living room.
Yeah.
They were manufactured in Hong Kong or in China through Hong Kong, and we were getting slapped with big import duties. So we're figuring that out. Not quite there just yet, but we will keep.
I just saw Yara say something in the chat. I'm just trying to, like, you know, she brought it up, so I thought maybe it was current events. I don't want to put you on a spot.
We're figuring out a way to avoid the import duties. I believe it's in the process of being worked out. Although, yeah, we had some people get slapped with some big FedEx bills from the customs.
So, but the North
Myself
American
included. What's that?
So the North American folks are going to be able to get the good price soon. That's great. That's
We're working on it. So
a
little more patience, but hopefully there soon. And glad to see you're thinking Silver Chopper Ben. Obviously important in these time periods. Who knows? Maybe that might be the solution at the next policy meeting on Wednesday. Maybe they'll just say they're going to put Ben up in his helicopter, but
That's right.
We shall see in just a couple of days. Although Vince, I thank you again for joining me. Thank you everyone at home for tuning in, and hope you found this helpful. And we'll see what happens by next week, my friend.
Thanks.